Hello, everyone. My name is Wayne Smith, and this is our Dividend Watch, part of 4D Finance News. The dividend that we're going to have on display today is ARR, Armour Residential REIT. REIT is REIT, and it stands for Real Estate Investment Trust. These are pretty good. I'm in several. I have been in Armour since November 22nd, 2022. And what I'd like to tell you about this is, first, a disclaimer. This is not financial advice. I'm not telling you to buy, to hold, or to sell ARR or Armour Residential REIT. I'm not qualified to do so. I do not have the proper series certification to do so. But I will tell you this. Yes, I am in it as of November 22nd, 2022. So why did I get into Armour? At the time, it was in the range of 22% yield. I looked at the dynamics of it, the fundamentals, and REITs are very interesting right off the bat. REITs not only invest in real estate in many, many, many different ways. It could be commercial, industrial, storage units. It could be residential homes that have been converted to duplexes, triplexes. It could be large apartment buildings. It could be housing projects. So there's a lot of ways real estate is used in this particular dimension when talking about a real estate investment trust. Armour is in residential mortgages, residential mortgage-backed securities, okay? At the time, it was 22% or so in November. And I said, well, I looked at the fundamentals and things of that nature, and I like it. Most people will tell you that if in the span of 6 months or so, its dividend yield drops, as it has in this case by 5%, that's a bad thing. You're in a yield trap. That's not true. Yield is a product of the annual. You take the annual price of the dividend, you total up for the whole year, and you divide that into the price of the stock. And that's how you get your yield. Okay, it's a percentage. The yield will be a percentage of the stock's price. Now, what people don't tell you is, or maybe they don't think about it, this yield dropped 5% because the price of the stock was more expensive. The actual price of the stock started gaining more value. And so here we are. It's a 17.9% dividend yield, and it's trading around $4.92 at the time that I'm making this video, which is the 21st of March, around 11:23 a.m. So think about it. The stock price is inversely proportional to the yield and vice versa, because they're based off each other. This 17.9 dividend yield pays out every month. So take a look at this. Yes, again, in November, investors were looking for a safe, ultra high yield monthly dividend stock with long-term growth potential. This is growing. The investments are primarily fixed rate loans. The company essentially raises capital by issuing debt and then reinvest that capital into higher yielding debt instruments. It returns it to investors via share buybacks and stable ultra high yield monthly dividends. So I just recently got paid on this particular stock a few days ago, and I saw that hit my account in my brokerage. Here's some developments. In the third quarter of 2022, that's when I purchased it, basically, it purchased 780,000 shares at an average of $4.96 a share for $3.9 million. In the fourth quarter, it repurchased 449,700 shares of common stock at an average of $5.01 a share. So that was 2.3 million. They buy back their own shares. Okay. That can stimulate the price too. In November, its dividend yield was, like I said, 22.9. It's 17.9 now. And the reason why it's fallen, I want to reiterate this so the point gets hammered home. It's fallen because the company's dividend going down is when its share price goes up. It's been trending higher and higher since then, especially since October of 2022. And so it's distributed about almost $39 million in dividends, or about 32 cents a share. Now, the company itself, it experiences a 10-cent a month per share dividend, basically somewhere in that area. So that is a great rate of return, and it's stable. Something I didn't mention about real estate investment trusts, because they borrow money, usually at very favorable interest rates, and re-lend it out, they get tax breaks by issuing the dividend. The specialized tax break they get is because they will have to issue a dividend to you, the investor, at 90% of their profits. So 90% of their profits have to be reinvested back to you, the real estate investor. That's not a bad deal. And that's for the privilege of actually borrowing money at a very low rate of interest. And the give back is when they do that at 90%, they get a very good tax break. So it's an outstanding mortgage REIT stock. It's seen its share price rebound over the months. I encourage you to investigate it. And of course, by all means, get into and have a part of your portfolio in dividend, high yield, dividend producing stock. And I say high yield is over 8% for me. That's all for ARR. ARR, again, is the stock ticker for Armour Residential REIT. And this is it for 4D Finance Dividend Watch as part of the 4D Finance News. Take care. Have a wonderful day.